What's up, edge traders? This is Adam Winnig here with another video to help make your trading easy, lucrative, and fun. With that being said, in this video, we're going to be talking about something interesting. We're going to be talking about a concept called candlestick price action. I know you may have heard of price action before, but I'm not sure if you've heard about candlestick price action. We're also going to be talking about something called Wick Fills, and we're also going to be talking about something called Candlestick Trends. I know you're familiar with normal trends, but I'm not sure if you're familiar with this type of trends that can help give you a serious edge in your trading. With that being said, to make your trading easy, lucrative, and fun, go ahead and click the subscribe button and turn on post notifications so you don't miss any important videos to help make your trading even more effective. So let's get in and actually talk about this. And this was a huge aha moment when I first learned this. And I actually learned this from this guy named Raja. Maybe you've seen his videos on YouTube as well. I'm sure he's probably not the first guy that discovered this or figured this out. I'm sure he learned it from somebody else as well, but I did learn it from him. So I like to give credit where credit is due. And this is a really cool concept that once you see it actually playing out, it's going to make a ton of sense and it's going to help your trading become even more effective. So let's take a look at this. So normally we're used to seeing, when we're talking about trends, we're used to seeing something like higher highs and higher lows, right? A higher high and a higher low, a higher high and a higher low, a higher high and a higher low, right? This is the Bitcoin daily chart. As you can see here, we're in this big bull run here, but that's how we normally think of trends, right? A higher high and a higher low, but also you can see trends in individual candles themselves. So how does this actually work? Well, if you are in a trend, then candlesticks should also create higher highs and higher lows. So let's take a look at this. So we're looking at an uptrend here and we see that the very low is right here and the very high of this candle is right here. Okay. Now, if we're truly in an uptrend, then the next candle is also going to print a higher low. Okay. See, it's higher than the previous low and a higher high, right? The high is higher than the previous high. Okay. And the next candle, same thing, a higher low. Okay. The low is higher than the low of the previous candle, and the higher high is higher than the previous high. Okay. It's the exact same thing in a downtrend. And I'm going to show you why this is key and how this can help you get more favorable risk to reward trades and also help cut your losers smaller and help your winners ride longer. So in a downtrend, it's the same thing, right? You can see that here's the very high of the candle and here's the very low of the candle right here. On the next candle, we see the highest point at this point where it's actually making a lower high, which is characteristic of a downtrend. And right here, we see it making a lower low, which you can see right here. Okay. Next candle, we see it's actually making a lower high again and a lower low again right here below here, which is really, really great. Okay. So let's take a look at this. You could pull this up on any chart, but just take a look at this one, for example, and I want to show you a few examples, and then I want to show you how to put this together, how it can make you a more effective trader, okay? So let's take a look at this. So for example, right here, we see just upwards movement, and we'll look at a couple different examples, but here's some upward movement, right? We see this big candle here showing that price is going in an upward trending fashion. And what do we see here? We see price making a higher low as well as making a higher high, right? This low is higher than the low of the previous candle, and this high is higher than the high of the previous candle, right? Okay, what do we see happen here? The low is higher than the previous low, and the high is higher than the previous high, right? Even in this case, right? And even this candle, even though it was technically a bearish candle, we can see that the low is higher than the previous low, and the high is slightly higher than the previous high, right? Which is great. Now let's take a look at just another example here, like on a downtrend. We'll see here that in this scenario right here, we can see that the low is candle starts right here, and then we see what happens. Okay, the highest point is right here, and then the highest point is right there. So it's making lower highs, and it's making lower lows. Look, the lowest is down here, and the lowest is up here, so it's making a lower low. It's again making a lower high and a lower low, lower high, lower low. Even with this candle slightly, it's making a lower high and a lower low. And you'll notice that in a trend, candles do this a lot of the time. And here's how you can actually put this to use. So let's say, for example, you're going to enter in this upward trend, right? Since we believe that price is likely going to respect the previous low of the candle in an uptrend, the previous high in a downtrend, we can go ahead and put our stop loss right below the candle. So in this scenario, you see you can put your stop loss right here as price moves on up, okay? And we see price move on up again. We expect price to respect this low. So we can move our stop loss from below the low of this candle to the low of this candle, right? And then after this next candle forms right here, we can bring our stop loss to respect the low of the next candle, respect the low of the next candle, respect the low of the next candle, right? And that's how you can cut your losers smaller and make your winners bigger, okay? It's the same thing in a downtrend, just the opposite, right? In this scenario, as price moves down, we can continue to move our stop loss to respect the high of the previous candle. So you want to just stick your stop loss right above the high of the previous candle, and as each new candle prints, you can continue trailing on downwards just like that, okay? Which is really, really cool. Now, here's something interesting, okay, called Wick Fills, which was a new concept to me when I first heard about it. But usually I thought that when you see a big long wick, it means that there's this, price exhaustion that's happening where price tried to go higher and it couldn't go higher than this, and price came back down and it settled right here, right? So it showed that there was exhaustion, that price didn't want to go there. Well, there's something interesting that I learned, again, from the same guy. Basically, if a candle prints like this, where there's no real wick, it's kind of just filled to this point right here to the high. So meaning that the close and the high are about the same. There's like a 50% chance that this trend, the next candle, is going to continue to move higher, okay? Which is good, but right, in trading, we just want to slightly stack the probabilities in our favor. So he's actually mentioning that there's actually a greater than 50% chance that wicks actually get filled in between a zone. Now, that's a key thing, in between a zone, and I'll explain what that means in a second. And I'll show you how this all fits together, okay? But basically, all we're trying to do is stock the odds slightly in our favor. So 50+%, that's great. We want to take that slight edge, right? And here's the deal, okay? If this was a zone, meaning that, the zone is like right here. This is the resistance zone right here, and a wick pushes into that resistance zone, then this rule may not apply. However, if you're in between zones, meaning there's a zone up here and there's like a zone down here, right? And you're kind of in between in no man's land, then more likely than not, the wick is likely to actually go ahead and get filled and prices continue on up until it hits like this next resistance zone, right? So again, a key distinction that, this wick fill doesn't always happen, but if you're in kind of in between zones, then it's more likely than not going to fill, at least in our researching and our watching of the markets. The same thing in a downtrend, obviously just the opposite, right? Same thing right here. There's no wick. Okay, so the low of the candle as well as the close of the candle are basically the same. And then in this scenario, we have this wick right here, right? Again, same thing. We expect higher than 50% chance that price is likely to move on downwards and fill this wick. Okay, now why? Why does that actually happen? Well, if you take a look at this, it'll help you understand it. So let's break it down. Let's say that this is a daily candle right here, right? We have the low, we have the open, the close, and the high right here. And then if we break this one candle down and we break it down to the 4-hour time frame, there's obviously 6 candles that make up the daily time frame. 6 times 4 makes 24 hours in a day, right? So there's 6 candles here, and we can see what happens. Well, when you look at it here, we can see the low matches the low in this 6 candle segment here. We can see the high matches the high in this 6 candle segment, and we can also see the open. The first candle is where the open is, and the last candle, where the last candle closes, the close on the daily as well. Now, why do we say that this wick is going to get filled, which you saw here in this just diagram, the wick filled? Well, why do we say that the wick is likely to fill? Because if you look at the price action that's actually happening on the 4-hour time frame, you'll see that what is price doing? It's making a higher high, and it's making a higher low, and a higher high, and a higher low. So it's just in its own little trend here. Just when you break it down to a smaller time frame, you're able to actually see that even better, right? So what do we expect? If this is an uptrend, right, we see higher high, higher low, higher high, higher low. What do you expect? We usually expect it to go to a higher high, right? So the trend to continue more often than not. So That's how this works. Okay. Now this is an interesting concept, right? Using the candle trends where you can, trail your position at this point, as well as using the concept of Wick Fills and bringing it down to a lower time frame to see what's actually going on during that higher time frame. You can see it busting out here, right? This is all great. And the only bad part about this is, well, I guess it's not bad. It's good. It's an edge. It's something that can take your trade to the next level. But the only thing is that, as you probably know, we cannot control the markets. Okay, we have no idea whether the market's going to continue on upwards, going to continue downwards. We have no control over that. The only thing that we actually have control of is really our risk management. And I want to show you guys a risk management secret that can make you up to 40% more profitable. It'll make your winners even bigger than what we talked about and make your losers even smaller. And this can make all the difference in your trading system. So if you're new to here and this is your first video you've watched, click the subscribe button, turn on the post notifications so you don't miss any of these. And also I'm going to include a video right here that's going to show you a risk management secret that can totally change the game and make you up to 40% more profitable. So go ahead and watch that right now, and we'll see you in the next video.